generational wealth, pride of ownership, real estate. Have you been getting ads like this from a whole bunch of different fractional real estate platforms? And maybe even some platforms that are pretending to be fractional real estate that aren't really. I'm thinking about, I get some of the best ads out there for real estate investing, I think, come from this Invest with Roots company, which I think they're marketing super slick. I'm not a fan of their platform whatsoever. I did a video about it a while back. You could search it. As someone who, thinks of himself, this is me I'm talking about, as very analytical, I hate that most of the marketing around fractional real estate investing is focused on these vague notions and feelings. Like, generational wealth is this term that gets thrown around by people in the investing world in general. And I think it's a silly concept, right? Like, there's no specific asset that is going to lend itself more to being handed down necessarily than anything else. And I think about that. And if I wanted to, I invest in physical metals, real estate, mortgages. I don't really invest in stocks anymore. I used to quite a bit. But the reason I mentioned the metals first is I think that's one of the things that is, if I were thinking about what's actual generational wealth, like, because you hand over something physical to somebody and, it's whether it's in a safety deposit box, which hopefully it is, right? Like, don't keep this stuff in your house and then get robbed. Be smart about it. But like, that's something that I can see as, okay, it gets handed over and it's like a hassle for them to take it somewhere to sell it. So, that it's got a little bit of stickiness that makes it maybe more generational. I think when people were buying whole, if you're investing in whole properties, because that sale process is, cumbersome and annoying, that's one of the reasons that properties got handed down, right? Like, if I owned investment properties and then I died and my kid took them over, if they're being properly managed, it's much easier to just leave it with the manager and keep collecting fees or keep collecting rents than it is to list it for sale and whatnot. So I think, when people look back and see, okay, well, real estate has gotten handed down more than stocks or something, I can see that. But I think that the reason has been, just because you don't have to have the same sort of trust and estate type planning to make sure, to make it more difficult to sell, right? Like, if you hand over a stock portfolio to somebody, they can sell it the next day online if it's through an account. But at the same time, you could put it in a trust. You could hire, an attorney for some estate planning, and you can create generational wealth today with just about any asset. So, when you hear when that stuff gets thrown around in some of these ads, it just drives me crazy. And it's like pride of ownership. Like, okay, when I'm buying fractional real estate, I'm never going to go touch these properties. It seems, it just really, it rubs me the wrong way. I understand that it works because I think lots of these companies are using, similar ideas in their ads, and I'm sure that they're doing it because it works. But I wanted to bring it up because I want to make sure, I want to talk a little bit about what my goals are and talk about if you have certain goals with fractional real estate, does it mean that certain platforms might, fit better than others? And so, I don't know. I have my little sticky note just to make sure I don't get too far off track. You know that I always do, though. And the other thing, people, they talk about appreciation. Well, okay, that's, I think, again, sort of a vague notion, but it's something that we get from real estate, right? Or tax advantages. I am a big fan of the tax advantages from real estate. I've benefited from them quite a bit. I think most of the people investing in fractional real estate have no real sense of what it is, what the actual advantages are that they're getting. They're like, oh, well, I can put the depreciation on my tax return. I've heard people say that a bunch of times. But they don't really understand the impact of it, right? Like, is it that is the income from that property just being offset by depreciation? So I'm making cash flow without, taxable income. I think that's where we stand with a lot of these. I don't think beyond that, and obviously everybody's tax situation is different, and you want to talk to your tax professional about how this could impact you. But I don't think for the most part, most of the people investing in fractional real estate are going to get any additional benefit beyond that. Some of them, depending on the setup, you might have a piece of a REIT, even though it's fractional real estate. Sometimes the entity is, has made a REIT election, and you're just actually getting a discount on the dividends that you get paid. And so one of the things I want to mention about the taxes, I think I've made some comments in the past based on a misunderstanding that I have of how some of the platforms are treating the taxes. Because I was watching one of the videos that Arrive put out recently, and it sounds like they're not, you're not just getting, I don't know, it sounds like maybe you're getting a little bit more of a benefit than I thought you were. When I was comparing their product to Moguls, I was thinking that they were going to be treated differently tax-wise, and now I'm not so certain that is the case. It makes a big difference for me because I'm a real estate professional, and it, depending on a number of things that go on when I'm doing my taxes, it could, there's certain ways that I could be able to offset it against some active losses. Or active income if I wanted to, if I have some passive losses. But anyway, that's getting way too far outside of thing. What I really want to think about is, okay, what's our goal with fractional real estate? Or what's our goal with investing in general, right? Because you might, if you really dig into your goals, you might have gotten duped by some of these like really feeling-based marketers and realize like, oh, you know what I'm trying to do, maybe some other, maybe I should go buy some lottery tickets instead, right? Like, and honestly, like with the way some people behave on some of the platforms, that seems to be their goal, right? So I think in general, when I'm investing, I think there's three things that I'm looking for, right? Or three things that could be the main goal. I think you could be going for growth. You could be going for cash flow, or your main goal could just be capital preservation. And then, if your goal is growth, you might be looking at some sort of, you might want predictable, stable growth so that at some certain point in time you can retire, or convert that portfolio to cash flow. Or you might be, hoping to retire next year, and you're really, the type of growth you're looking for is more like buying lottery tickets than anything else. If you've been somebody who's invested in crypto, and I say invested that way because most of the time I think of crypto a lot as speculation. And I don't see anything wrong with speculation provided it's being done in a prudent way. But I think it is very much like you can make it is very much like buying lottery tickets. Now, whether or not it is an advantaged bet or not is the only real argument to be made here, right? Because if you're saying, okay, I'm going to get outsized returns in the future, there's no way to value the fundamentals of the asset. Well, then, yes, I'm just making a bet that this property is going to be worth more in the future than it is today. There's no intrinsic value that I'm basing that bet on. It is, lots of different things. I know there's lots of crypto guys that watch this that are not going to like that characterization. Just know I don't think it's bad, right? Like there's definitely a large portion of my portfolio that is speculation. And I think that it is, I'm trying to set it up and it's stuff that I don't talk about on here because I don't want to get other people to do really dumb things like what I do, and possibly just lose all that money. Right. And that's where you kind of have to be. I think in general, fractional real estate doesn't lend itself very well to that, crazy high upside type speculation. So, but if that's, if the absolute highest returns possible is what you're going for, and regardless of your risk, I think in my mind, Lofty is the only game in town right now, right? You can make, of all the platforms I invested in over the past, year and a half of doing this now, Lofty is the one that I've made the best returns on. Saul's Lot, I've had some deals make incredible returns. I'm going to basically stop covering that platform for a little while because I think they're just kind of winding down and not going to be doing anything other than just getting rid of the properties that are on there. Before I forget, please like and subscribe. And I mean that, you guys. I know I have tons more people that watch videos on a regular basis than are actually subscribed, so you should do that if you haven't already. Also, in the description of this video, I have links to all the places where I'm currently invested in fractional real estate online. Please feel free to use any of those links. Go to those platforms, look at the properties, invest in those, but do your own due diligence, right? Don't do it because I put them there. Don't do it because I'm investing in there. I'm just, sharing the info about what I'm doing for your information and convenience. You want to make sure that what you're doing, as far as your investing goals and your risk tolerance and everything is going to be much different than mine. So you want to make sure to do your own due diligence, make sure that you're buying the stuff that works for you, not just what I say I'm doing. Also in the description of this video, I have a link to the Discord channel that I set up, where a whole bunch of us fractional real estate investors go every day, talk about lots of different platforms, lots of different properties, different strategies. Please feel free to join. There is no cost. It's not a sales funnel. If you get DMs from someone who looks like me after joining, please report them. It's not me. I'm never trying to sell you anything in the DMs. Okay, so back to here. If my only goal is I want to get the fastest growth possible, at the moment, I think Lofty is the only game in town. You have 24/7 trading on here, right? And so you can buy and sell. You have the absolute deepest discounts, relative to everything else. But keep in mind, more people have lost money on Lofty than made money. I feel pretty comfortable saying that at this point. Because your average, could that really be true? It seems like that's true, and I don't fully grasp how that's possible, right? Because it seems like a zero-sum game, but it's not because there's fees. So yeah, I guess that makes perfect sense. But your average token price is so low, and it has been creeping up lately, but it's so low relative to the initial token price that there is at this point, it's a fact of the system that there is downward pressure on pricing once a property is tokenized on the platform. But those very deep discounts provide a lot of opportunity for outsized returns. For me, that the main strategy for achieving that has been buying the discounted tokens, pushing for property sales in real life. Once the property sells in real life, getting a multiple, getting some large premium over what I paid for the tokens. For the most part, that strategy has worked very well for me. I've had a few that I've lost money on. I've had some where I've made tremendous returns. But it is, if all I'm concerned about is trying to maximize my return regardless of risk, this is the way that I would go about it. And at the same time, I think that if you are really prudent about the way that you look into the properties themselves, you can get rid of a lot of the risk, right? Because having a low basis in a property is a protection, right? Like it reduces your risk, provided that you actually have a good understanding of what the property's worth. So most of the time when I've run into problems with here, it's either been that the sale process has gone horribly because of the governance system and the co-owners and the way the voting works, or it's been that the property was significantly worse than what I could tell from all the available information online. Both of those things are risks in this system. But anyway, if that's the goal, pure growth, no matter the cost, the Lofty, I think, makes the most sense for that, right? And so it is why I am going to leave some portion of my investments on this platform. Now, that's not the way they're designed, right? I think they like you to invest in properties on here for the long term, and I think that you can. For me, it doesn't seem like it's the best place for that. What's the next goal, right? Cash flow. If all I care about is the highest cash on cash return and getting monthly cash flow relative to my investment, for me at the moment, Mogul seems to be the clear winner, right? I think you have to avoid the short-term rentals on their platform. Those haven't done well for me at all. But if I look at my portfolio of pad splits on here, they've just created really strong cash on cash returns. You can see my annual yield is, on average, my total yield is very low. But when I pull out all the short-term rentals, then I get, I believe, over 10% yield on here. Now, are you going to get that on properties going forward? Maybe not. Maybe your yields are starting to decline and you're going to get like 8 to 9%, current yield. For me, this has been the best place for me to find cash flow. ARC 7's not too bad, right? I think my last, in all, I want to make it clear, I've only been investing on some of these platforms for a few months, some of them for longer. Mogul I've been on for over a year now. Lofty I've been on for over a year. Ground Floor I've been on over a year. Arrived, ARC 7, and Real Bricks are all relatively recent. I didn't even put Collab on here because I am invested in Collab as well. I have gotten pretty steady dividends from Collab, but again, not the. Well, I guess, because I only invested in 33 Mine, my dividend has been pretty stable at this 7.5%. So, I guess I hesitate to say, put them in the same boat as Mogul because to me, it feels much more risky. Their platform, their deals just don't seem to be selling out. They recently froze trading so they could re-up their SEC documents. I think that's just something that they have to do, but I don't get the same feeling of security with them. I also, if I had bought a basket of their properties instead of just one, their average yield is significantly lower. That's the same problem that I see on Arrived, ARC 7, Real Bricks, all of those, their stated yields, 6%, sometimes 4 or 5. ARC 7 always, 4.89. Like, we just see a lot of these lower yields. And so if my goal is purely cash flow, Mogul is the only real game in town. They're just slightly higher, right? But again, it is, it hasn't, their short-term rentals have really let me down. So if that were my goal, as I'm continuing to build a portfolio, I'm going to have to not buy the short-term rentals. Now, some of the private credit funds, the on Ground Floor investing in notes, their actual notes, not the LROs. I think both of those are places where you could maybe get predictable cash flow. I don't think of either of those as actually being fractional real estate, and so that's why, I didn't really pull those into the discussion. But so, one of the things I should have mentioned before I started breaking this up is like, why would I want to have either of these, right? So a lot of times, people get into real estate investing in general and they're like, oh, cash flow. I read Rich Dad, Poor Dad. I'm trying to replace my income with cash flow. That's the first thing that I want. A lot of times that's a sort of the wrong way to go about, if you're trying to retire as early as possible, which is a lot of people's goal, buying cash flow assets first is often one of the slower ways to get you there. Because often the properties that are spitting out the most cash don't have the highest total returns, right? They don't appreciate as fast. You maybe aren't getting a discount up front. And so you're not getting the highest total returns, which is why when I said, if I want cash flow, I'm probably going to go on Mogul. If I'm going to try to get just the absolute highest return, I'm going to do some trading. I'm going to try to get some discounts, make some active income, and I'm going to try to be on Lofty. If, say, for example, I wanted to retire tomorrow and I had a big chunk of cash to invest, well, then it would make sense for me to invest it all in something. Well, maybe for me, right? It would make sense to just buy the assets that spit out the cash, and then I'm just living off that cash flow. If I thought, okay, my goal is to retire in 10 years, well, if the cash flow investment is underperforming relative to the growth investment, it would make sense instead for me to buy the investment that's going to grow the fastest. And then as I get closer to the time that I want to retire, sell that, 1031 exchange it if it's a real life asset, or, however it works, convert it into a cash flowing asset. And so we have a significantly larger amount of money that we can, convert into something that's cash flowing. And, when you compare those two strategies, a lot of times the strategy that focuses on growth ends up with more cash flow at the end of the day, as long as you've successfully converted the asset, right? And I've done this in real life. I've had a lot of clients who, some who bought for cash flow immediately, and it's tough to slowly build your wealth with $100 or $200 or $300 per property profit each month, versus, okay, I bought a deal, maybe it doesn't cash flow at all, but I picked up $40,000 in equity on the purchase, right? And because nobody else wanted it because it wasn't cash flowing, and then I sold it a couple of years later, and bam, now I have a bigger chunk of money. I made that money right away. So that when you're thinking about, is the goal cash flow or is it growth? How realistic is it that you're going to retire tomorrow, or next year, or 5 years from now, versus 10 years, or whatever the timeline is, should inform the type of investment that you're looking for. And then, I compare those two quite a bit. For the last one is really asset preservation. And for a lot of us who have been investing for a long time, who don't necessarily need the investment to continue to grow very fast, and the thing that we're looking for the most is that we, to avoid future losses, that's the goal, right? Asset preservation. Now, one of the things, okay, so a lot of people are, well, put that in an FDIC insured, bank account. Well, then your cash, you can just lose value relative to inflation, right? Inflation eats up the value of your cash over time. And so that's not necessarily the smartest place for asset preservation. I've been someone who, like I mentioned early in the video, I think I did, that I invest in metals. Physical metals, obviously you got to keep them somewhere. So there's some cost to that. Safety deposit boxes aren't that expensive. Don't keep them in your home if you do that, because you're just going to get robbed eventually. So please be smart about it if you invest in physical metals. Those, I think, a lot of people look at as a good store of wealth. But if you look at the way that the prices have moved on silver or gold over the last several years, it's not this stable store of wealth that it once was. I mean, the pricing goes all over the place, and you're like, oh, well, it's relative to the dollar. It is to a certain extent, but it's also relative to the cost of my mortgage, which is denominated in dollars. It's also relative to the cost of my groceries, which, you would think if it was all about the erosion of the dollar or the fluctuations in the dollar, then my grocery bill shouldn't vary at all relative to the value of gold, but it does, right? So it's not necessarily the best asset protection anymore, or at least it's not pure, right? And for me, silver's been a fantastic investment over the last couple of years, or for anybody who's bought it, it has been, unless you bought it when it crossed over 100 recently, which I know a lot of people who did, right? Jumped in, bought silver for the first time after it had quadrupled in value. So don't be that person. Anyway, but if asset protection is the main goal, right? For me, I think it makes more sense than anything else to invest in debt. It's one of the reasons over the last several years in real life, I've converted a lot of my portfolio to mortgages, to private mortgages. So I sold the property in real life. In return, I receive, a promissory note from the buyer. They make me payments. and then I have a mortgage in place that I can foreclose if they don't make those payments. That for me is, it does create good cash flow, or it can if you do it right. But it is, owning mortgages, I think you have a significantly less chance of getting wiped out than owning equity, especially if it's levered equity. I mean, when you have a property and you have a mortgage on it, it's perfectly possible that you lose your entire investment. And so, Mogul, that's every property on Mogul, right? They all have mortgages. Perfectly possible that if they underperform, they get foreclosed on eventually. Real Bricks is an all cash investment in properties. And so, that's something that they push heavily. Arrived has had some of both, right? They have some that are debt free, some that have debt. I think ARC 7 is the same, right? And so, if you're thinking about asset preservation, having no leverage makes a ton of sense, right? Now, it slows your growth. It could reduce your cash flow, and that's counterintuitive to some people. They're like, well, I'm not paying a mortgage, I should have more cash flow. Well, yeah, but I'm not paying a mortgage, but I also didn't take whatever money I had from that debt and go and buy another levered property with it, right? So anyway, I think that unlevered real estate is a pretty good store of wealth. For me, I think I'd even rather have the debt, right? And so the LROs, like if all I care about is asset preservation, I think ground floor makes a ton of sense. If you I can't think of who it was, like Mattress Money, something like that, posted a video that was in our Discord. Sorry, I don't know exactly who it is. But yeah, jump in our Discord, look under ground floor. There's a video in there today about performance, his performance on ground floor. And you can see even the worst investments on there, the ones that defaulted, I think he was saying his average loss on those was 15%, right? On the defaulted ones. Which is amazing, right? Like if you think about, okay, what are your worst losses on Lofty? Well, some people have been wiped out, virtually altogether, maybe not 100%. There's been some properties that were sold for $50 initially and recently sold for single digits in real life, right? So people have lost 80% of their value on this platform. I think, Brownfield could turn out to be a total loss. We'll see, and I think some of the other levered investments could turn out to be total losses. Some of the ones where someone stole a deed could, and of course on ground floor, there's the potential for some of the notes to be a total loss as well. But it is, I always look at being a debt investor as being one of the most secure positions, right? Provided it's, the loan is backed by, there's obviously a lot of caveats to that, right? Like if I'm investing in credit card debt, that's not the same as if I'm investing in mortgage debt, right? If I have 90% LTVs on that mortgage debt versus 50% LTVs, I wanted the lower LTV, right? There's all these things. Yes, it's not just, okay, it's a mortgage, it's safe. The biggest thing for me, and it's especially true, so I have a mortgage in real life that I have a borrower who's 2 full months behind right now. And, we've worked out a payment plan and I'm perfectly happy with it. But as I'm not getting paid, I don't have any associated payments. So, for example, if I own this property in real life, or if I own this property, through any of these fractional sites, and the tenant's not making their payment, well, I still have taxes, I still have insurance. I might still have, HOA fees. So even if there's no debt, when I have a tenant in place who's not paying, or I have a vacant property, it's still costing me money every single month. The same can't be said for a mortgage, right? If I hold the mortgage, I'm the one who is due the payments, which is the position we're in when we have a LRO. If that borrower is a default and they're not paying, there's no corresponding cost that we're having to cover every month. And so that's why it's a position that I look at as being one of the safest positions, right? Because I can hold that mortgage forever at no cost, and use it to collect when the time is right. And so that's why, for me, I think ground floor is one that I was really excited about early on. I'm hoping that, they had that automatic payoff or artificial payoff at one point in time where a whole bunch of my LROs got paid off. And it was it was very aggravating for me because I ended up with just cash in the account that I had to do something with and didn't have any place to invest it. As long as they avoid doing that, this will eventually be a platform that I'll move. I think a very large portion of my net worth I'd be comfortable putting on a platform like this, provided I can spread out my investment over 100 plus loans, right? Which again, that diversification I think is good for asset preservation. And provided that they continue to do a good job servicing it. Now, I'd love to see some other fractional debt platforms, pop up as well. I know there are some commercial ones that I haven't really covered because you have to be an accredited investor. Sometime when I have time, I might dig into those for myself. But in general, I think, if the goal is asset preservation and you're in fractional real estate, I think, yes, one, the unlevered properties, but you still have some issues there, and then the loans, right? I just wanted to break all that down because I think I get a lot of questions from people in the DMs and in the Discord, and like, well, what do you think I should invest in? Do you like this one? Are you? And like, if I think about where I am in my investing cycle, I still do some investing for growth more than anything because it's the more fun, exciting, engaging part. I'm definitely at a point where I'm shifting from cash flow, cash flow to asset preservation. Like, these are my main goals right now, right? Yes, I'd like to keep growing my portfolio, but more than anything, I don't want to lose money. And I'd like to, I don't pull any money out of any money out of my fractional real estate for investing at all right now. I do take some portions of the private mortgages that I have, comes to me for living expenses. And that'll be, as I wind down my business, that will be my main source of income. But it is not, the goal there to keep that going is to not lose money, and not, there's not any, this is all unnecessary information, but it is, my only point is that I don't necessarily have the same goals as you, and your goals, you could be much further along in asset preservation. Like, some of the people that I talk to on here have very high paying W-2 jobs. They don't plan on leaving them anytime soon, and they're really just building wealth for retirement. Well, if that's you, probably this predictable growth might be what's important to you. But if you've already, some of the people I've talked to have an absurd amount of money already invested. And if that are already, saved up, and they still think, oh yeah, I don't think I'm going to retire maybe 10 or 15 years. Well, okay. Am I just concerned about asset? If I'm that person, do I even need to be in fractional real estate? Maybe, right? Maybe it's a good spot for really strong diversification, strong asset preservation. But you also have to remember, okay, we've got this platform risk, right? This is a new industry. It's not necessarily even the one, ground floor, I think, has been around 10 plus years. But, other than that, I think what has arrived at like 5 or 6 now. I'm not sure. All of these platforms have some degree of regulatory risk, some degree of, there's all these different things that could come into play that, even though this is what my channel's about, this is what I'm talking about every day, I don't necessarily think fractional real estate investing makes the most sense for everybody, right? I think And I think I say the same thing about real estate investing in general, right? Like I think it is a fantastic way to build wealth early on in your life. Like I think, house hacking makes a ton of sense. Doing live-in flips makes a ton of sense. If you're someone who's going to get into the industry, doing actual flips, doing burrs, all that type of stuff, fantastic ways to build wealth. There's a certain point that you can get to that you might not need to be in this industry anymore. Does it make sense to just buy REITs and sit on those? Well, I prefer fractional real estate to REITs. But I'm also someone who's willing to take the time to continue to do due diligence on individual properties, right? If I'm willing to give up some of my safety or return in order to spend less time, that's going to change which assets I invest in quite a bit. I don't know. I know that kind of just covered a lot of random stuff today, starting off talking about the feelings that are created by fractional real estate investing advertisements. But it is, I just want to make sure. I think a lot of people get into pick different platforms and pick specific properties and do it without really thinking about, okay, what is my goal, right? What am I trying to get out of this? Am I trying to retire tomorrow, right? Am I buying a lottery ticket? Am I trying to retire in 10 years? Am I trying to take a pile of cash and turn it into cash flow? Am I just trying to put my money somewhere really safe, right? Like all of those are different things that I could be attempting to do. It could be some blended strategy across those. But until you know which one you're going for, you can't really answer, is this a deal I should invest in? Is this a platform I should be investing on? Is fractional real estate even right for me at all? Right? All of those things, the answer to those all matter on what you're trying to get out of this, right? And it shouldn't just be like these vague notions of generational wealth, or I want to be a mogul, or investing in real estate is what rich people do, right? Like, and none of that matters, right? Like that's all just like ethereal. Like it's not the stuff that you should be thinking about, in my mind, when you're making these decisions. Now, obviously, if you've got enough money and you can just make emotional decisions, that's kind of I know some really old or some really rich old dudes that do just make most of their money decisions at this point based on how it makes them feel. And I think that's a legitimate choice too, right? Like it is, they're giving away massive amounts of their wealth, or they're just investing in certain people's deals just because it's fun or exciting or whatnot. I mean, that stuff happens too. And at a certain point, money is just a tool. So I get that. Man, this is like, yeah, I think that's everything that I want to talk about with this, right? The main goal is, if you're coming to me asking, should I buy this deal? What platform should I invest in next? Make sure you're ready to answer the question, what are my goals? What am I looking to grow my wealth as quickly as possible? Am I looking for slow, stable growth? Am I looking to throw off cash flow that I'm going to spend, right? Cash flow, the goal should be not reinvestment, but to spend, if that's the main goal, is the cash flow. Or am I just looking to protect my capital, right? All of those things are, I think if it's not one of those three goals, I mean, maybe, I do get people that come to me in real life and buy properties to lower their taxes. I don't think fractional real estate's the way to go if that's it. Now, obviously, you got to ask your tax provider about that. The biggest one that we see people use is the STR loophole, with bonus depreciation. But that's definitely a strategy that is not for everybody. Can be tremendous for some people, right? Like so it could be to reduce your taxes. Maybe I should add that, but I don't think that's if you're investing in fractional real estate, I don't think it's the right vehicle to help you there. At least not at the moment. Okay. That's everything. I think that's the whole video for today. Hopefully this was helpful a little bit to put some points on some thoughts that maybe people have about what they're doing. Anyway, until next time, I'm going to just keep making mistakes so that you don't have to.